Imagine you're handed a $5,000 prop firm account. Sounds like a pretty decent chunk of capital to make some real moves, right? Well, here is the brutal mathematical reality that wipes most traders out before their morning coffee even gets cold. You don't actually have $5,000. Because of a razor-thin 3% maximum drawdown limit, your actual tangible risk capital is just $150.
Okay, let's really dive into this, because this single constraint changes absolutely everything. Could you survive the incredibly volatile financial markets with literally only $150 of breathing room? If you approach this swinging for the fences trying to get rich quick, no way. You're going to face instant liquidation. To survive and eventually generate some massive profits under these strict constraints, you have to completely abandon those retail gambling tactics.
So welcome to The Explainer. Today, we're digging deep into the source material to uncover the exact systems you need to shift from a game of chance into a highly professional, institutional-grade operation. We are looking at a fascinating survival playbook designed specifically for navigating these incredibly tight prop firm challenges. Because as you'll see, your primary job isn't actually making money at first, it's survival. Your secondary job is capturing those high-probability setups to eventually scale up.
To get there, we're going to follow a highly structured 4-pillar roadmap today. First, extreme micro-risk management. Second, executing the A+ institutional setup. Third, navigating the prop firm scaling path. And finally, building a dead calm mindset.
All right, kicking things off with Pillar 1, extreme micro-risk management.
Listen, in professional trading mastery, capital preservation beats profit every single time. If you don't survive, your strategy honestly doesn't matter. Let's look at the math. Standard retail advice usually says, hey, risk 1% of your account per trade. But with a max loss of just $150, just 3 losses and you fail the challenge immediately. To survive, the sources emphasize risking no more than 1/4 to 0.5%. That is just $12.50 up to $25 per trade.
And this brilliantly illustrates what professionals call the probability jar. Think of it like this. Every time you take a trade, you're pulling a random marble from a jar. Some are green for wins, some are red for losses. By risking only $12.50, you essentially give yourself 12 red marbles, or 12 consecutive losses, before you face total failure. That is the statistical breathing room you absolutely need. Outcomes in the short term are completely random, but micro-risk ensures you actually survive long enough for your trading edge to show up over time. This brings us to the seatbelt principle. It's perfectly summed up by TradeCity in our sources. Your stop loss is a seatbelt. You don't put it on because you expect to crash. You put it on because if you do, you survive to drive again. On a micro account, you also have to enforce a strict $100 daily limit. If you hit that limit, you trigger an immediate walk-away rule. Boom, done for the day. This acts as a mental circuit breaker, totally preventing that emotional urge to revenge trade and blow your entire account. Because ultimately, survival means valuing the process over the P&L. You have to focus on the quality of your execution. Now, you might be wondering, what makes a trade good? Well, if you follow your rules exactly, but lose $12.50, the market simply handed you a red marble. That was a good trade. Conversely, if you break your discipline, go completely rogue, and actually make a profit, that is a bad trade. Why? Because you just reinforced a toxic habit that will inevitably cause you to blow your account down the road.
Moving right along to Pillar 2, the A+ institutional setup.
Okay, so secondary to survival is actually making a profit. With micro-risk, the only mathematical way to generate big profits is by capturing high-risk to reward setups using smart money concepts. So the crucial point here is entering the market only after everyone else gets trapped. This introduces a fascinating concept, the liquidity sweep. This happens when the price deliberately pushes past an inducement, like a fake support level, just to trigger retail stop losses. Once the retail traders are totally cleared out, the big banks step in and the real move begins. It's wild. To capture these moves, professionals use a surgical top-down execution model. Step 1. Establish your higher time frame narrative, usually on the 4-hour or 1-hour chart, to make sure you're aligned with the big institutional engine. Step 2. Identify a point of interest, like an order block or a fair value gap. These are basically the footprints left behind by massive bank momentum. Step 3 is the real secret sauce. You wait for the price to sweep that retail liquidity. And finally, Step 4, drop down to the 1-minute chart and wait for a lower time frame change of character, or COHCHO for short. That's your definitive confirmation that the institutions are finally stepping in.
This precise approach allows for an incredibly tight stop loss. Instead of a typical retail strategy that targets a standard 1-to-2 payout, this institutional setup can yield massive 1-to-10 ratios. To put that into perspective, when you're only risking $12.50, catching just one of these trades banks you $125. That right there is the true mathematical secret to turning a small account into big profits, without ever over-leveraging.
Which brings us to Pillar 3, the prop firm's scaling path.
Here is where you need to completely shift your paradigm. Stop trying to flip a small account. Actually, scratch that. Banish the word flip from your vocabulary. Professional mastery involves viewing that $5,000 challenge merely as a stepping stone. You need to settle for modest 2 to 5% monthly returns. On $5,000, that's only a profit of $100 to $250. You aren't doing this to buy a Lamborghini today. You're doing it to generate a bulletproof track record that proves you can manage capital. Let's see how this actually builds real wealth over time. In months 1 and 2, you generate those modest single-digit returns. Once you have that proven track record of consistency, you use it to unlock, purchase, or earn much larger funded allocations, like a $100,000 or even a $200,000 account. By month 5 and beyond, you're applying that exact same 2 to 5% return, but now it's on massive capital. That's how you hit those 6- and 7-figure payouts.
And these aren't just made-up numbers, folks. Traders analyzed in our sources report massive payouts, scaling from $485,000 all the way up to Desi Trades securing over $2 million and JadeCap reporting payouts of over $4.5 million. They absolutely didn't achieve this by gambling. They did it by applying modest institutional gains to massive funded capital.
And finally, we arrive at Pillar 4, building a dead calm mindset.
Let's be real for a second. 90% of traders fail. And they don't fail because they can't draw a trend line. They fail because of their own internal psychology. The market is basically a giant mirror. It reflects all your internal insecurities right back at you, triggering emotional reflexes like FOMO, greed, and the urge to revenge trade. As Styx Trader points out in the source material, the market doesn't destroy you with a losing trade. It destroys you the moment you break your discipline. One impulsive, emotionally hijacked moment can literally wipe out months of patient execution.
Now, what's really interesting here is this actionable blueprint to combat human error. You have to move your brain from an excited state to a completely neutral, dead calm state. Perform an internal reset before you even look at the charts, making sure your logical prefrontal cortex is driving the bus. Next, enforce the rule of 20. Don't judge your strategy until you execute 20 to 100 trades perfectly according to your rules. This gives your brain the statistical proof it needs to stop sabotaging you. Finally, use a trading journal, like EdgeWalk or EdgeFlow, to act as a strict, impartial referee against the emotional lies you tell yourself during a drawdown.
Compounded discipline is the only true holy grail in trading. Professionalism isn't some magic dollar amount you suddenly reach. It's an identity you assume from day one. If you want to handle $1 million tomorrow, you must treat your $5,000 account exactly like $1 million account today. No exceptions.
So, let's bring this whole shebang together into a definitive summary. For risk management, never ever exceed $12.50 per trade because your total breathing room is only $150. Enforce a daily limit where you walk away immediately if you lose $100. For strategy, combine patience with precision. Trade with the 4-hour trend and wait for that retail liquidity sweep followed by a lower time frame change of character.
By combining extreme micro position sizing with surgical institutional setups, you can navigate even the strictest drawdowns and position yourself right alongside the top 1% of prop firm earners. So I'll leave you with this question to ponder as you look at your charts tomorrow. Are you just trying to gamble and flip $5,000, or are you ready to stick to the playbook and build $1 million identity? Think about it. And if you want to dive deeper into these institutional strategies, be sure to check out the sources we cover today. Catch you next time.